So the good news is South Africa has avoided a recession after a contraction of more than 1% in the second quarter of this year. Another quarter of contraction would have spelled recession. But growth data was released today showing GDP rose by 0.7% in the third quarter of this year. The bad news is that's below expectations, and of course it won't help South Africa to deal with our challenges of poverty and unemployment. The manufacturing and services sectors expanded in the third quarter, but mining contracted, and there you can see agricultural output fell by around 13%, showing that the drought is really biting in South Africa. Well, we couldn't bring this to you yesterday. We were on a live recording at Gallagher Estate, so we did speak to emerging market analyst for Nomura, Peter Attard Montalto, usually based in London but visiting Johannesburg. We asked for his global investor perspective on what is holding South Africa, what is holding our growth rates back right now.
That's quite hard to disaggregate because there are things, for instance, like China's impact on commodity demand, on metals demand in particular, from South Africa, where there is clearly an effect, a strong effect coming through in terms of trade, lower prices and lower volume demand as well. But then there are all the domestic factors that are going on around restructuring in the mining sector, job losses that are coming through. So it's quite hard actually to disentangle the two. I think what we could say is that South Africa could be going through a commodity cycle at a much higher growth pace, say going from 6% to 3%, where you would still be creating some jobs at that kind of level, as opposed to going from, say, 3% down to 1%. I think that's really where the sort of contrast has really played out around the domestic policy choices, the domestic uncertainty that's coming in to leverage those offshore factors, leverage those factors like China into the domestic economy.
One of the things we keep saying is that we want investment. You've said that global investors are still interested, but there's no love affair going on with South Africa. Just explain that a little bit.
Well, it depends if you want to separate out FDI, companies investing here, versus equity and bond investors. Equity and bond investors still see some pretty good valuation metrics given how weak the currency is, given where bond yields are at sort of 8.5% for 10-year bonds. There's still a degree of compensation, if you like, for the structural picture, for the weak growth picture in South Africa. So hence money is still sticking in with South Africa on the portfolio side. But it's not a love affair. People aren't saying I'm buying South African bonds because I think there's going to be loads of jobs created and very healthy economy. FDI is slightly different. There is FDI going on, but it's mainly brownfield FDI. Things like BMW recently announced another car model will be produced, but in an existing factory. The amount of pure greenfield job-creating FDI is actually exceptionally low in the economy. There are sort of famous headlines like Apple recently came here, but if you look at what happened there, they set up a service office. A few very highly paid individuals living in Sandton. This isn't your mass creation of jobs and manufacturing jobs, blue-collar jobs, which is what the country really needs.
And is there a lack of confidence? Today it came out that South African firms sitting on about 600 billion, I think it is, rand that could be invested. So if we're not investing in our own economy, is that another signal to global investors?
Well, exactly. The two key figures around that are the lack of private sector investment that's going on in the economy. We'll see that coming out when the SABC delivers their growth numbers in 3 or 4 weeks' time. And that's at sort of exceptionally low levels of basically flatlining in the last couple of quarters. That shows that the domestic population is investing onshore. And then the counterweight to that the SABC also produces is the FDI offshore investment data, where we see net negative FDI. That means money's flowing out of the country. More companies, South African companies are investing abroad than foreign companies are investing in South Africa. And again, that's really a signal about the lack of sort of policy certainty, the lack of vibrant economy. The cash situation that you mentioned is interesting. If you look at it versus GDP versus the cycle that we're in, it's not massively out of whack, and that's because people are investing offshore. There is a certain amount of money that is being put to use. So it's often a very political comment that people make around this pot of cash should be invested, it should be going to create jobs. But actually it's more important, I think, to look at the fact that the cash is flowing offshore to opportunities, particularly in the rest of Africa.
Rather than coming here. You mentioned policy uncertainty, and this is something that investors harp on continually. What is expected of government? Where does the uncertainty lie?
Well, I think it's mainly a trust issue. If you actually sort of nail down within, for instance, the Investment Promotion and Protection Bill, there's nothing dramatically sort of off, kilter about where investors actually want that piece of legislation. The whole issue around, for instance, the Investment Promotion and Protection Bill is the trust issue where foreign investors, particularly mainland Europe investors and US investors, are seeing the cancellation of bilateral investment treaties. They're seeing the opportunity potentially for government to open up expropriation in the future. All these sorts of questions start coming up. So it's more a question of trust on things like that bill specifically, as opposed to the line by line of what the legislation is actually saying. But more generally, there's uncertainty, for instance, regardless of what sector you're looking to invest in. If you look at, for instance, the securities bill around the private security industry, that's a piece of legislation that is against WTO rules, that is sitting on the president's desk now for about a year, where even if you're not investing in that sector, investors are looking at that, looking at the requirements for more than 50% ownership. We've had, obviously, from the NGC recently talk about that in the farming sector as well. People have in the back of their minds, will that happen in my sector? Will it happen in the car sector, for instance? And that's where the uncertainty comes from.
And like you say, it takes more than a year to get a decision. So you want decisions made quickly.
Exactly. And ultimately, what the message I always give government is, we kind of don't mind what you do, as long as you do it quickly, you do it efficiently, you do it transparently. We can work with that. Obviously, we would hope there would be free market policies and structural reforms, but as long as the government is transparent and doing things efficiently, regardless of where the policy actually is, that's the first step, at least, for foreign investors to gain confidence, and local investors.
Peter Attard Montalto speaking on South Africa's economy. Now, today, the